From Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Good afternoon, this is the COB. Great to have your company. My name's Kyle Rodder and I'm, of course, with Juliet Saleh. Juliet, great to have you on board.
Thank you. So fun to be doing this with you on a Friday afternoon on an interesting week for markets, hasn't it been?
It certainly has been an interesting week and a number of fronts, and we, of course, will tackle all of those issues. But let's just check where the market has finished for the day's trade now. Really grinding lower into the close. The CBO 200, well, up perhaps a fraction here, 0.15%.
Yeah, and I think a lot of the heavy lifting in the latter part of the trade particularly is coming through from these miners, particularly as you saw that surge coming through in the iron ore price. So you've got the likes of BHP, Rio, Fortescue all up by more than 1%, and also some pretty good movement coming through from healthcare stocks as well. But as we know, the banks have certainly been under a bit of pressure.
Yeah, indeed, and actually it's the right time perhaps to pick up on some of the areas of the market that were, well, stronger and perhaps a little weaker today as well, starting with, well, the real estate stocks. REITs, perhaps, if we can, having a few issues with that graphic. Let's get to the utilities though. Another area of the market that we were keeping our eye on. There we go. Broadly higher across the board, interestingly enough. I'm not too sure if there was anything there in particular, especially in this environment of rising rates at the long end, while utilities might be pushing high. It could be just a little bit of a rebound, but seeing some strength across the board there. And the telcos in focus too.
And I mean, the story of the week has really been Telstra, hasn't it? With that $2 billion profit, but one investor describing the fact that shareholders aren't going to be getting a short-term sugar hit from a potential return of capital as a bit of a disappointment, and you have seen a bit of a sell down coming through. In the telco holding just above $4, there are 9 Entertainment a little off and 7 West Media down by about 2.8%. We did have 7 Group, of course, reporting this week too.
Yes, we did. And Ryan Stokes did provide us with a little bit of time, so if you want some colour on that, you can go to your platform and we'll get it straight from the proverbial horse's mouth, of course. But Juliet, 3 themes. Let's go through them all because I kind of get the feeling that the market was hit from all sides this week. And, well, we were talking about what the theme should be. I thought I would channel my inner Dr. Phil, not just because of the haircut, but also real rates. Let's get real. Real yields in the United States hitting levels we haven't seen since 2007, I think it is.
Yeah.
And whenever that happens, of course, that's going to compress valuations across other asset classes.
Yeah, it's all about being these rising bond yields. You know, every morning we wake up and watch that and the impact that has had to global equities as well. And Larry Summers, the former US Treasury Secretary, also saying, look, you could be expecting an average of about 4.75% in the next decade. So, of course, the big flow-on effect there in terms of what that means, as you say, to valuations as well. I mean, Evergrande effect, this is one close to my heart because I covered this stock for years in Hong Kong and Singapore. And, you know, it is a company that has just been in the doldrums for so long and finally filing for that Chapter 15 bankruptcy in the Manhattan court. The stock hasn't traded since March last year, but you've got these other flow-on effects of what it means for the broader property sector, for the China slowdown. Country Garden now in focus too. Is it going to have to default too?
Yeah, definitely. And well, we spoke a little bit about the materials and the weakness a lot this week that we experienced, but that was a real weight on the market down, I think almost 4.5% over the course of the week. And we've already touched on it a little bit there, but earnings season volatility, we've seen plenty of that. We're going to have Dr. Shane Oliver coming up. He's got an interesting chart about, well, some of the hits and misses of companies. And it really seems to me, anyway, that the most difficult thing for coming out of this earnings season is just simply trying to get a good feel of, well, where earnings ought to be on the upside and the downside as well. So big hits, but big misses too.
Yeah, I think interestingly, some of the companies have probably paid dividends that investors weren't expecting, or even special dividends, and we've seen that with a number of stocks that have been surprising to the upside. I personally don't think it's been as bad as many feared, but I know that is a personal opinion and others have different views, but it does come down and who cares what I think anyway? Let's get what Dr. Oliver thinks in a little while.
Yeah, and so it certainly will. But let's just recap some of the day's earnings. It was a little quieter today, almost fortunately, because we had, of course, one of our first Super Thursday yesterday, and actually next week's going to be even busier. But Latitude did report, and well, the embattled, well, what would you call it? Finance company down, posting a very significant net loss, $98.2 million, and a lot of that was to do with that cyber attack that disrupted operations throughout the last financial year.
Yeah, ongoing pain point there, and the fact that it's not going to pay a dividend really leading to some investor pain point as well too. If we look as well at Centuria Capital, it was back into profitability. The group's assets under management, $21 billion, stat net profit after tax, just under $106 million. So that was a company that did, I guess, come with some good numbers coming through. And a pretty good distribution there too. Yeah,
indeed. Abacus Group also reporting today. Group statutory profit 95.1%, down 95.1% to $25.5 million. Distribution per security 18.4 cents. So that was another in focus today. But last and of course not least, Juliet, Magellan. Yeah. Speaking of embattled companies.
Speaking indeed, but again, getting to that point of announcing special dividends, I mean, nearly 40 cents there, or a 30 cent special dividend, but a dividend of nearly 40 cents as well. So I think that's why you can see such immense speculation and interest in this stock today when you're going to potentially get a payout of 70 cents. Net profit after tax coming in at $182.6 million. They do continue to see funds under management bleed. The company really struggling to revive its once, I guess, high-flying status and the profits that we used to see from Magellan.
Indeed, and it was one of the market leaders throughout the day, and as a result, we thought we'd make it our stock of the day. Danny Akiye had a chat with Luke Winchester from Merewether Capital, as well as Henry Jennings from Marcus Today. Have a listen to what they had to say.
Performance is improving. The management seems to be on top of things. Special dividends. Now, before we get carried away with this, because we have seen a lot of volatility in the market recently with these results, and some results, they get a big spike on the result, and then they fall away afterwards. So it'll just be interesting to see how we react on Monday. But certainly this is a much better result from Magellan. Andrew Formica coming on board as well. He's quite well respected in the industry. So that is a positive as well as the chair. And as I say, it is all about funds performance. Once you get that going and you can crank up the marketing machine, you can get funds under management up. A little bit ritzy for my liking. If it came back on next week, and we've seen this with some of the stocks that have performed pretty well on results, if it came back 5, 6, 7%, back down maybe to sort of 950, 980, then I'd probably look at it.
I think you would hold it here. I know 20% is a big move, and I agree with Henry. On these numbers themselves, you probably say it's a bit too much, and you probably can sit back. If you're on the sidelines, sit back, and you probably can pick it up a bit cheaper as it just drifts back a little bit. But it's not expensive, particularly if you sort of subtract that roughly $1 billion of assets off their market cap.
Okay, so I won't be going to the investment committee, but the guys there are saying that maybe given the big sell-off we've seen in Magellan over the last what's it been, 2 years now, there could be value starting to emerge. I guess we'll just keep following those funds inflow and outflows because they have been bleeding.
Yes.
Over the last
good term for that.
Yeah, indeed. But let's get to our guest for the COB, and as always on a Friday afternoon, Dr. Shane Oliver from AMP joins us now. Dr. Oliver, great to have you on board once again. It's been a debate this week in the newsroom. Has this been a better than expected earnings season, or perhaps worse than expected earnings season? We've got a nice graph which spells it all out for us. But what's your verdict so far on what we've got from company reports?
Look, I'd say it's probably better than expected, or at least better than feared. The share market is still down, but that's because of other things. I think, there was a lot of fear and uncertainty going into this reporting season, but by and large, companies have actually, if you look at the upside surprise on that chart there, back in the last reporting season, it was just 27% upside surprise. This time it's around 45%. A few more disappointments, but by and large, that is an improvement. So I think the big surprise, though, was the extent that retailers have been quite strong. Many retailers have seen a rise in profits, and that's seen their share price respond accordingly. But you've got to be a little bit cautious there, because if you dig beneath the surface, they are warning that a lot of that strength was either in the first half of the financial year, which is the December half, or if growth continued into this calendar year, it started to slow off in July. So there are a few warning signs in there that retailing, at least, is certainly starting to slow down. Likewise, when you look at some of the building material companies, good news there, but GWA were warning that demand for things that go into kitchens and bathrooms looks like it's starting to slow down. So there are some warning signs there. The other thing to note is that the profit growth expectation, I think, was something like 2% coming into this reporting season. And the expectations for the current financial year, on my reading of it, have, if anything, been revised down further. They're more negative than they were when we started the report being released. And we also are stepping down from 22% profit growth in the previous financial year, in 21-22. So we have seen quite a sharp slowing in profit growth. And there are those telltale signs there, particularly from retailers, building materials, and we also seen that slow down in terms of resources companies.
Well, let's talk a little bit more about that too, Shane, because especially when you start to look at the China activity and what that means for the commodities picture, the concerns in the property sector still ongoing, and we have seen quite a bit of a spike in iron ore today. But what are you seeing in terms of the China activity picture?
Well, it's pretty messy. This week we got a good update on that earlier in the week, and all of the indicators there for retail sales, industrial production, investment, property investment in particular, or property construction, property sales, they're all on the weak side. It's always hard to interpret Chinese data, and that chart there does look kind of messy, so we've had to put a 3-month moving average through it. But we did see that initial spike going into the early part of the year, but that seems to have faded quite substantially. And we're now starting to see economists revise down their growth forecast for China for this calendar year. And then, of course, you've got these property issues going on in the background. I mean, Evergrande today declaring bankruptcy in the US. I think that's just a Chapter 11 to protect their US business or suits coming from US creditors. But so there's nothing necessarily new in there, but it does highlight the ongoing issue, particularly given that we've had those problems with Country Garden. We've got those issues with a Chinese bank that's stopped some of its payments on its mostly property-related funds. So there is an ongoing issue there. And the bigger picture issue in China is that for many, many years, it recirculated or recycled, if you like, its very high savings rate. They save about 45% of their GDP. We in Australia save about 25% of our GDP. So there's a lot of money that has to be recycled. They would typically do that with very high levels of fixed asset investment to feed the export markets. But of course, that has become more problematic with geopolitical issues and other things. And then some of the money started to go into property markets, and that looks like it's come to an end as well. So you've got this country which has a chronic excess savings problem, very different to many other countries. And if you don't find avenues to spend that money, you end up with deflation and ongoing potential stagnation. So they do have to try and resolve that. They really do need to try and find ways to get consumers in China to spend more and save less.
Just on that, and potentially around the remedies to this issue, because a lot of folks have been saying that, well, we're seeing some sort of parallels to Japan in the 1980s in particular, that China is heading for some sort of balance sheet recession, and really the only remedy to sort that out will be, well, the government effectively being far more active on a fiscal side to try and stimulate things. I mean, do you feel as though, especially next week, we've got some more news coming out from the PBOC as far as monetary policy, that really it's going to require a fiscal impulse to try and, well, turn the ship around, so to speak?
Look, I think it probably will. It's interesting you were just making that reference to Japan. I mean, so many times you see the headline turning Japanese after the song. And in fact, I've got a report I was just looking at right now, which has that very same headline. And it's been applied to various other countries over the years, but most recently, of course, to China. And there are those parallels there. I guess the big difference is that Japan made its way to being a rich country or, a high income country before it started to slow down, whereas China is still a fair way away from that point. But anyway, there's a longer term issue there. I think they do need fiscal stimulus, and that's probably the only way out of this. They have to find ways to help the Chinese consumer. They need more in the way of social security, so people feel that if they get sick, they've got adequate backup. And likewise, more help for when they go into retirement and with education. So all of those things need more spending to help the Chinese consumer sort of start spending more and saving less. And I think we probably will see that. It's hard to see the Chinese authorities just sitting by and letting their economy stagnate or worse. Obviously, they've been reluctant under the leadership that's been in place since 2012, 2013 to embark on big stimulus programs because it can lead to imbalances. But by the same token, I still think the new leadership or the leadership we now have do not want to see the Chinese economy collapse to the extent that they have social unrest.
Shane, your take on the unemployment rate, which ticked up to 3.7%, the level that we hadn't seen since April. How worrying is this, or does it show some kind of resilience when you look at the fact that it was at 3.6 and now we're at 3.7?
Well, it's, there's two ways to look at it. You could argue that it's been range bound for a little while there at 3.7, 3.6, back down again and so on. But it looks to me like it's bottomed. You can see that zigzaggy pattern in the blue line on the chart there, which is the unemployment rate. So it's been zigzagging around a bit, but it looks like we did see the low at 3.4% in October last year and sort of a mild trend up since then. Likewise, the underemployment rate is doing the same thing. It bottomed at 5.8% early this year, now 6.4%. So seeing a bit of an uptrend there. The thing that makes me aware that the likelihood is we'll see more upside is the other part of that chart there, which was the blue line, I think it was, which showed the ratio of job applicants for job vacancies on the SEEK website, and you can see that there is quite a sharp rising trend there. There's more people showing up to apply for jobs. Likewise, it's the black line actually. So don't get hung up with the levels; they're always different. Focus on the direction. The direction for that black line, which we've shown with the 3-month lead, is up, and that tells me, or is a warning sign, that there's more people out there looking for jobs, and at the same time, we've seen a decline in the number of job vacancies. Business hiring plans are looking less favourable. And also the Melbourne Institute survey asked consumers what they're expecting regarding unemployment. That's also started to edge up. And historically, that's had a good leading relationship to unemployment. So all of these things are coming together, and I think they're pointing to a further softening in the jobs market ahead, which, of course, is what the Reserve Bank has been wanting to see. And ultimately, that will mean will take pressure off wages growth, and I think it provides them with scope to leave interest rates on hold at their next meeting.
Shane, on a slightly lighter note, perhaps, seeing if we can get the chart up. I don't think we have it in the system right now, but some curious economic behaviour around the Matildas match on Wednesday night. What can you tell us about that?
Well, someone discovered that little note there from Sydney Water. And Sydney Water obviously track water usage continuously. I didn't realise they had the ability to do that. So through the course of the night, the use of water across Sydney declines. There's a declining trend. But it started to fall quite dramatically after the opening of the first half. And then there was a well below trend, and then it spiked above trend in the middle of the match. Everyone obviously rushing off to get a cup of tea or go to the loo, whatever, and then of course came down again and only picked up again once the game was over. So it certainly, we debated it all week. What would be the impact of a public holiday? What would be the impact in terms of the economy, the economic boost from the Matildas winning? And but it looks like we're not going to get the public holiday, unfortunately. And they were knocked out, which was a very disappointing evening to see, but they still got a lot further than I and anyone else thought they would get. So I think in that sense, I think we're all feeling very, very happy here. But there's the chart there. You can see the way the water usage on that Wednesday night fell way below normal after the initial kickoff, spiked again at half time, bit of a break, and then fell way off again. And of course, the other lesson in all of this, eventually everything gets back to the trend. So you can debate Taylor Swift economic impact, the Beyonce effect, Olympics and all those sorts of things. Ultimately, you just end up back on the trend, which of course what happened is what's happened with water usage.
Maybe a quick shower at halftime there. Shane, just on that point, as you say, the Matildas did very well. They've made us all very, very proud. On Sunday, who do you go for?
Certainly
do you go for England because if they were going to knock us out, then at least they should win, or do you go for Spain?
I'll go for Spain. I'm one of those perverse people, being Anglo-English heritage. I should go for the UK, but I'll go for Spain out of interest. But it'll be interesting to see how it goes. But there's no doubt Matildas did far better than many would have thought. I mean, most people weren't even aware of it that was coming along. So it's certainly put women's soccer on the map again, and that is fantastic. When you put that together with the Barbie effect, which makes a lot of people think about gender roles in society, then these have to be seen as positive developments.
Yeah.
Indeed. Dr. Shane Oliver, vamos into the weekend. Thank you so much for your time and have a great weekend. Dr. Shane Oliver from AMP.
Thanks, Carl.
I haven't got authority too that there was actually another line on that chart as well for the English water use.
Yes.
We couldn't see it because they actually don't bathe.
Oh, I bet you're actually going somewhere with that. Well, look, he makes a very interesting point, and the Barbie effect too. I've certainly been very much, I think, seen that maybe 3 times now.
Oh, have you really?
Should I?
So rather than doing the Barbenheimer, you've just done Barbie times 3.
I've just done Barbie times 3.
I haven't done it yet. I'll have to.
It's a great movie.
Okay. Let's get to the leaders and laggards, shall we? And we've already spoken about Magellan and what was driving that today. So, some embattled shareholders may be seeing a silver lining there. Abacus Group, Goodman Group also rising, interestingly enough. And Ingham's following through from yesterday's results.
I think that's really interesting because it had quite a few broker upgrades as well, Ingham's, and that's based on the fact that we're going to consume more chicken and more poultry, and the rising prices, of course, was very much behind their results as well. Let's have a look at the laggards today. Super retail, of course, continuing to be under pressure. And Imugene, I don't think I'm saying that right, but we spoke to the CEO earlier in the week, didn't we? And Centuria Capital was one of the ones that we were pointing to earlier at the top of the show as well.
Indeed, yeah. And Imugene just there, an institutional placement today announced, I think $35 million. So raising capital, never great news necessarily for existing shareholders.
Yeah.
But some big investments there planned for the company. Let's go to the small cap leaders and laggards. There we go. Just some big moves. Sezzle did have some updates during the week on its listing on the NASDAQ. Otherwise, I'm not too sure if there's anything driving some of those larger moves, although a little bit of, an exposure there you can see to the resource space, which bounced back slightly today. Laggards in the small cap space, though.
Yeah, we're looking at Audio Pixels, the biggest decliner, down by more than 15%. Invictus Energy also being hit quite hard there, down by about 9.5%, and Meteoric Resources too. So some quite big moves, as always, you see in the small cap space.
Yeah, it always ends up being a bit of a bingo game at the end of the day when we get to some of those small cap names. But there you go, if you're in any of those, now you know. But let's move on and just very quickly get to what we're looking at in the week ahead. And there's a lot going on. I feel like I've really undersold the number of results that are going to be dropping next week. It's huge, but you've got
I looked at
BHP.
Monday's calendar. Good luck. I'm not here on Monday. It looks crazy.
I'm feeling anxious about it already. Looking forward to the next 2 days off to gird myself. But of course, there's going to be plenty on the macro front as well. PBOC policy on Monday actually expected to ease some of their key interest rates further. Global flash PMIs during the week too, and we'll get the wonky members of the world. Jackson Hole, to look forward to.
Always a very big meeting there at Jackson Hole. So we'll be seeing as well, of course, the moves of the Fed, particularly when you had the Fed minutes this week suggesting that there was a little bit of perhaps not consensus on whether or not they've done enough tightening yet. So big week ahead. Good luck on Monday.
Yeah, absolutely going to need it. So let's see where we finished up very quickly in terms of the CBO 200 and the ASX 200 as well. And there you go, CBO up by 0.15%. The ASX 200 has, barely eked out a gain with a slight drop in post-market trade. We're up by 2 points, 0.03% for the week, down by 2.62%. So not a great one for investors. I think we've made it pretty clear at this point. There's a few things that are worrying folks out there, but that's the week that was. And I get the sense that, like you said, Juliet, there's going to be plenty more to sink our teeth into come Monday.
Yeah, absolutely. August always incredibly busy, not just here in the Aussie market with the results, but as you said, we've got Jackson Hole, we've got a lot happening globally as well. But that is it for Friday, isn't it?
That is Friday. Remember, you can catch up on all the content from today and throughout the week on our website, Nat. But Juliet, it was great to be in the driver's seat with you today. Have a lovely weekend.
You too. Thanks,
all right,
Kyle.
see ya.